Hi, good morning, everybody. My name's Adrienne Marks, and today I wanted to partner with Scott Shang, who is one of my lender friends. And I had this idea a couple of weeks ago, and some of you actually helped me with this. I posted on Instagram a question to you guys to ask whatever questions you had about getting qualified for a home loan or buying a house. And so after I compiled the questions, I got with Scott, and he graciously agreed to let me interview him to get all of your questions answered. So, Scott, why don't we get started?
Absolutely, and thank you so much for having me here. This is so much fun. When you told me what you did, I was just so excited because any opportunity that we have to answer questions and help consumers when they're not face to face with a salesperson and feeling like they're being pressured or feel like they're being told or asked, what the salesperson wants them to hear. So this is super, super cool. And I think this is indicative of the type of professional that you are. So it's an absolute honor. And I appreciate you having mommy here or having me on here.
Yeah.
Yeah. So you want to dive right into it?
Okay. Yeah. Let's go ahead and get started. Okay. So the first set of questions have to do with down payment and closing costs. And there's several of them. So the first one is, how can I buy a house with little or no down payment? So that's what everybody wants to know. Let's hear what you got.
Well, this is a really funny question because I'll tell you, I am shocked at how many people think that they need 20% down payment to buy a home.
Right.
And it's absolutely not, that's not at all true. So here we're in Southern California, right? You're Southern Orange County.
Yeah.
You can use FHA government insured financing with a loan up to $726,000 with 3.5% down payment. So that's about what, $25,000 or so in your $700,000 range. That's crazy. Conventional, a non-government loan, because people will say, oh, I don't want a government loan necessarily. I just want conventional, because for whatever reason, they think conventional means it's a better loan. But it's not. It's just different. Your minimum down payment up to that same amount is only 5%. That's nothing.
Wow. Yeah. That's
and
totally
then if we're lucky, and if we're lucky enough to run into a veteran, somebody that's served in the military, they can buy up to that $726,000 with zero down payment, like no money down at all. So you can absolutely buy a home with little or no down payment. The actual down payment requirements are relatively small in almost all cases. So yes, you can absolutely buy. A home with little or no down payment.
Yeah. Okay, so I'm gonna kind of I just thought of something that other people might ask in relation to this. So what is the trade-off if you don't put 20% down?
Oh, that's a good question. So there are different terms. So every single program is different. Every single loan program is different. And essentially all a mortgage loan is a risk assessment model. So based on your credit and your income and how much money you have, the cost of the loan is determined based on how many risk factors they determine and how many what they call compensating factors. So if you're putting 20% down, you're reducing a ton of risk for the lender. You're going to find that you're going to have lower interest rates if you have 20% down. Anytime you put less than 20% down, you pay what's called mortgage insurance. And mortgage insurance is one of those things that people are afraid of and they think it's a bad thing. But I think it's one of the best tools for buyers that's out there ever. It's an insurance policy that the buyer pays for every single month. It's part of your mortgage payment, a couple $100, and it protects the lender in case you default. Now, the great thing about that is for a couple $100 a month, I cannot have to come up with $40,000 or $50,000 in down payment.
Right.
So putting a down payment and hedging that risk is one of the greatest homebuyer tools that exist out there. So those are kind of the trade-offs. You'll find a little bit better terms. And also, if your credit isn't perfect, and you try to get approved with some programs, like a conventional program with less than 20% down, there's a higher probability that you may not get approved if there's not enough compensating factors. So then you would shift over into like an FHA, which is much, much more flexible, allows the same loan amounts, but it's just way more flexible and allows it a lot more people to qualify for that. So there's always options, and you're going to get sick of me telling you this, but it depends.
Yeah. Okay.
That's almost always the answer.
All right. Perfect. The next question is a little similar to this, and is zero down really real? Like, can you actually buy a house with zero down? And I think you touched on that a little bit.
Yes, you can, but the question then becomes, should you? Or do you want to? Now, there are obviously programs out there that are designed to be 100% financing, like USDA rural development. You're not going to find that in South Orange County necessarily. Actually, I think there is a USDA eligible area up in Trabuco Canyon, like a little teeny tiny spot. And then veterans can do 100% financing. Other than that, you're talking about assistance programs. And assistance programs, I don't remember if we get into that really deep, but they're very expensive. The interest rates are really high. The payments are really high. They typically, in order to do zero down, you're really not always doing zero down. You have what's called a silent second mortgage. So you've got liens against your house for the money that the assistance program is giving you. So while you as the buyer do not necessarily need to come in with a down payment, you're borrowing the money and not making payments on it. And there's a significant cost to that. I would say 99.9% of the time when I show folks numbers side by side with an assistance program, and then here's all the other ways you can get your down payment and closing costs covered, they almost never choose the assistance program, because it's what I always say is if you have no other options, those are amazing programs. But if you have any other options, most people try not to. So is it real? Yes. The more important question probably is it the right program for you?
Okay, very good point. And some of what we just discussed led in a little bit to this next question, which is, how can I get down payment assistance?
Yeah, so the state of California has the California Housing Finance Agency. I've heard a lot of people call it CHFA, call it CalHFA. It's calhfa.ca.gov. That's the official home buyer program for the state of California, and they have some amazing programs. What it actually is you're borrowing. This is those silent second programs that I was talking to you about. So you're borrowing the money. It's a lien. There's no payments on it. Sometimes there's an interest rate. Sometimes there's not. And the state of California allows you to stack those programs on top of each other. There was a grant program that was out there for a little while that was discontinued. That was the NHF Sapphire, and a lot of people know that name. There's another another grant program out there. But again, the way that these things work, they tend to be somewhat complicated. Like for the grant program, it's not a lien, but it's a really high interest rate, and you have to keep that high interest rate for a minimum of 3 years before they forgive the grant. So again, that falls into the category of yes, there are programs, but really just dig into it. The one thing I would recommend is don't get caught up in the romantic thought of getting free money, because nothing is free, and it's actually very, very expensive. And it's expensive to the point where it will prevent you from, it will put a cap on how much you qualify for, because the rates and the payments are so high on it. it puts a cap on how much you qualify for because you're going to max out your payment. Also, those buyer assistance payments don't have the flexibilities that other programs have. So there are additional restrictions like income and debt to income and things like that that make it a little bit more challenging.
Okay, so one of the things I guess I want to just restate that you mentioned is that if you get this type of assistance, it's a second loan on the house. You don't have to make payments on it, but you can't, in order to get rid of it, you have to actually refinance or sell the house. Is that right?
Yeah, so it used to be that that if you sold or refinanced the home, you had to pay off the silent second. They recently changed their rules a couple years ago, and now if there's a significant benefit to the consumer, they will potentially subordinate the second, which means they'll allow you to do a new first mortgage. Because remember, that's where they make their money. They give you the first mortgage at a really high interest rate, and that's how they're funding this program. So they don't want you, they make it really difficult. They don't want you to pay off that first mortgage at the high rate and get a lower rate on the first. It is possible, but when they came out with the rule, it was after the crash. So it was when we lost all of that equity and when interest rates went down into the threes, and they came out and they basically said, listen, this is going to benefit people, so we'll subordinate those second liens. Today, probably not so much because you're not going to have that huge benefit to the consumer. But yes, so as a rule of thumb, if you sell or refinance your home, you have to pay that off. And I guess real quick, I hope this isn't a rabbit hole, but this is one of the conversations I have with buyers is I tell them, listen, you might have $10,000 or $15,000 in a silent second sitting there. And maybe 3 to 5 years from now, you have some deferred maintenance. Maybe you bought the home. It was a little bit of a project. You knew you wanted to remodel the kitchen or the landscaping, and maybe you need $10,000 or $15,000 to do that. Well, now if you try to refinance to get that $15,000 out, you have to pay the silent second now. So now you're borrowing $30,000 and making payments on $30,000, and now you're making mortgage payments on $15,000 that you weren't making payments on before. So it's not that that's a bad thing, but I would consider that a surprise. If you didn't know that going into it, and then you tried to take money out and you realized, oh, I can't take money out or else my loan's going to go way up. I don't like those surprises. So those are why those conversations should happen up front.
Yeah. Okay. Well, that's a really good point, and definitely something that people should be aware of if they want to go down that path. So thank you for that. Okay. Next question. I owned a house 10 years ago. Can I still get down payment assistance?
Yeah. So this is good. Nice short one for you. The state of California and so way back in the day, 15 years ago, cities and counties also had assistance programs. Right. They've since pretty much all gone away, and it's mostly the state. But even when you run into them, the definition of a first-time homebuyer is typically that you have not owned a primary residence in the last 36 months. So yes, if you owned a home 10 years ago, you're absolutely considered a first-time homebuyer, and you would be eligible for any first-time homebuyer programs.
Okay, perfect. That one was short and sweet. Next is, what are closing costs? And why
that's a really good question. Yeah, no, that's a really good question. So yeah, for any home buyer, you essentially have two things that you need to worry about. You have your down payment, and then you have your closing costs. So the down payment is required by the lender, and there's restrictions on where you can get that from. It has to come from your money or a gift, or it needs to be source and season funds. But closing costs are all of the other costs that are involved in buying a home. So you have an escrow company, you have a title company, you have what's called prepaid. So without getting super complicated, when you rent, you pay your rent on the first of every month. When you buy a home, you're making your payment in arrears. So on the first of the month, you're actually paying the principal and interest for the previous month. So when you buy a home, depending on what day you close, the lender's collecting the interest for the time you close to the end of the month, and then all of the interest for the entire next month, because your payment is due essentially 2 months after you buy. So if let's say I bought a home here in March, my first mortgage payment is due in May. So as part of the closing costs, they're going to collect that interest. So those are closing costs. And closing costs, as a general rule of thumb, they tend to be about 2% of the loan amount. So that's a general rule of thumb. The cool thing about closing costs is they can be paid by almost anybody. So you can ask the seller to help pay closing costs. Those are called seller concessions. They could ask you as their realtor to contribute to their closing costs, and me as the lender also have the ability to help pay their closing costs. So we can essentially, and this kind of goes back to our earlier questions with down payment assistance. And this is where getting creative and working with people that are experienced, people like you that know how to ask these questions and try to find these questions. But this is really where you can get creative with this, and you really only need to come up with a down payment, because there's ways to get all of the closing costs covered. So instead of looking at buying a home and having this mountain of down payment and closing costs you have to climb, you really don't. You have to overcome that small hurdle of the down payment part, and we can cover the rest. So I don't know, I rabbit holed that a little bit, but I think there's an important distinction there. Yeah.
Yeah. Okay. And you actually answered the next question, which was, how can I estimate how much money I need for closing costs? And you said roughly about 2%.
Yeah. So all in, I mean, you think, so you've got 5%. So if you're going conventional plus the down pay, plus the, the closing cost part, you're about 5%, or you're about 7% of the purchase price there. And then you're about 5% if you're using like an FHA or government. But yeah, typically right around 2%. Now that can vary a little bit, depending on whether you have city transfer fees or special taxes or things like that. Also, the other thing that can impact that is whether you're paying your taxes and insurance as part of your mortgage payment. So if you are, that's called an escrow account. You have to collect that money up front. That's considered closing costs. So yeah, I did answer it, and I think I just answered it again.
No, it's okay. I know some of these questions you can just go on and on.
I know. I gotta be careful.